Hey guys, so in this video we'll be discussing warranties, which are also covered in the first part of intermediate financial accounting too. Now, there are two types of warranties. The first type of warranty is known as an insurance type warranty, and that's when a warranty is part of the sales price, and it's accounted for using an expense-based approach. The second type of warranty is called a service type warranty, and it's the type of warranty that is sold separate from the sales price, and it's accounted for using a revenue-based approach. So let's get to a question. The question states that Salzer Equipment Limited sold 500 Rolomatics on account during 2017 for $6,000 each. During 2017, Salzer spent $30,000 servicing the 2-year warranties that are included in each sale of the Rolomatic. All servicing transactions were paid in cash. The question goes on to say that to prepare the 2017 entries for Salzer using the assurance type expense-based approach for warranties. Assume that Salzer estimates the total cost of servicing the warranties will be $120,000 for 2 years. So let's get to it. The first entry we make is the entry for the sale of the product. Now, accounts receivable and sales revenue are debited and credited for $3 million. The reason for this is because the company sold products worth $3 million, and because the company is going to receive $3 million, accounts receivable and asset is debited for $3 million, and sales revenue, which is revenue that can be recognized because the product has been delivered, is also credited for $3 million. Now, the reason we get $3 million is because 500 is the number of Rolomatics the company sold, and 6,000 is the price per Rolomatic, so 500 times 6,000 is $3 million. So that's basically how it works. Revenue can be recognized because the product has been delivered. Revenue recognition principle. Because the product has been delivered, the revenue goes up by $3 million, and the accounts receivable go up by $3 million as well. Now, the next entry has to do with the entry for the amount spent servicing the warranties. In the first year, the company spent $30,000 servicing the warranties. So warranty expense, which is the expense amount, goes up by $30,000, and cash goes down by $30,000. The reason is because warranties, the expense of the servicing the warranties is the amount of cash the company used. The company used resources, in this case cash, of $30,000 to fix the warranties, to account for the warranties, and cash the resources for $30,000, and warranty expense goes up by $30,000. Now, the next entry has to do with the entry for the outstanding warranty amount at year end. At year end, there's still $90,000 left. Remember, $120,000 was a total warranty expense, and currently in the first year they used $30,000 of warranty. So $120,000 minus $30,000 is $90,000. That means warranty expense goes up by $90,000, and warranty liability also goes up by $90,000. The reason is the warranty expense reflects the amount of warranty that is still left, and warranty liability means the company still has to incur an additional liability of up to $90,000. The next entry has to do with the entry for the rest of the warranty use next year. So if the company used up the $90,000 worth of warranty next year, basically what happened is that you would debit warranty expense because the expense goes up, and credit cash because cash is a resource that was used by $90,000, and you get your $120,000, and that would be it. And then at the end of the year, you'd have to adjust the liability account to zero. So what you would do in this case is that you would reverse the entries essentially. You eliminate warranty liability because the company no longer has any liability at all. So you debit liability for $90,000, and the expenses are also eliminated, $90,000. So now the company no longer has to incur the liability. So you debit liability and credit warranty expense for $90,000, and therefore you're good to go. So that's how it works essentially for assurance type warranties. Now let's get to the next part of the question, which says prepare the 2017 entries for Salzer, assuming that the warranties are not an integral part of the sale, but rather a separate service that is considered to be bundled with the selling price. Use the service type revenue-based approach for warranties. So in this case, we're using a different approach. Now, it says to assume the sales total of $160,000 is identified as relating specifically to sales of warranty contracts. Salzer estimates the total cost of serving the warranties will be $120,000 for 2 years because the repair costs are not incurred evenly. Warranty revenues are recognized based on the proportion of costs incurred out of the total estimated costs. So we're told that the value of the warranty is $160,000, but the company is going to incur costs of $120,000 to repair the warranties. So let's get to it now. What we have to do here is that we debit accounts receivable. The company will receive $1 million in cash. However, only $2,840,000 is going to be recognized as revenue because $160,000 of the $3 million is unearned warranty revenue. The reason it's unearned is because the company has not performed the warranty services. Because the company has not performed the service, it's unearned revenue. The customers have given them money, but the revenue is not earned yet. The only revenue they've earned is $2,840,000 because the goods have been delivered, and therefore the revenue is earned. So $3 million is debited for accounts receivable, and sales revenue of 2,840,000 is credited, and unearned warranty revenue of 160,000 is credited as well. Because 160,000 is a liability, the company will have to it's legally binding. $160,000, the obligation will have to be met by the company in the future. Therefore, it's a liability. Now, what you do afterwards is that you would make an entry for the servicing of warranties the company spent the same year, and it's exactly the same. You would debit warranty expense for 30,000, credit cash for 30,000, and that's the warranty expense the company incurred. Cash is the amount of cash the company used up. Now, the other important part here is that you have to recognize warranties at the end of the year. So what you do here is quite different. You would debit unearned warranty revenue for $40,000, eliminating the $40,000 of unearned revenue. So $40,000 has now become earned, and because it's become earned, you credit warranty revenue for $40,000. The reason you do this is because the company's value of warranty was $120,000. However, the estimated cost of the warranties was $120,000, and the company spent $30,000 worth of materials on fixing warranty in the first year. So you would do 30,000 divided by 120,000 to get 0.25, which you multiply by 100 to get 25%, and then you multiply it by 0.25 by 160,000 to get 40,000. The reason you have to do this is because the value of warranties is $160,000. The cost of servicing them is $120,000, and the estimated cost the company spent on the warranties was $30,000. So 30,000 divided by $120,000 means proportionately 25% of the warranty cost has been used by the company. Therefore, the company can recognize 25% of the warranty's value. 25% of the warranty's value has been recognized. Therefore, the unearned warranty revenue of $160,000 now goes down by $40,000. So now it's $120,000 would be the balance in the unearned warranty revenue account. And sales revenue of $2,840,000 goes up by $40,000. So now the sales revenue is $2,880,000. Therefore, it's a way to balance it out, and that's the video, guys. So make sure you study the two warranty examples carefully. They might be in your exam, but also study the asset retirement obligation. Study these two. Thanks for watching. Good luck.